Welcome to this week's Market Update, where we review the key developments that have shaped markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story was the Federal Reserve delivering its first rate cut of 2025 with a 25 basis point reduction, bringing rates down to 4.0 to 4.25%. What made this decision particularly interesting wasn't the rate cut itself, rather the divisions it revealed within the Fed committee. Newly appointed Governor Stephen Miron pushed for a larger 50 basis point cut, showing there is still debate about how aggressively the Fed should be moving. However, the majority remained steady in their approach, signaling they're carefully balancing economic risks rather than reacting hastily. This measured response gives us confidence that the Fed is managing this transition thoughtfully, supporting both growth and stability. For our portfolios, this creates opportunities in growth companies that benefit from lower borrowing costs while maintaining defensive positions for stability. We also got encouraging news on import prices, which rose just 0.3% in August, despite ongoing tariff pressures. What's remarkable is foreign companies appear to be absorbing much of the tariff impact, rather than passing it directly to consumers. This suggests that inflation pressures from trade policies may be more manageable than feared, giving the Fed more flexibility. For investors, this supports companies with strong supply chain relationships and pricing power, while indicating consumer spending power may remain more resilient than anticipated. It reinforces our strategy of owning businesses that can adapt to changing conditions while maintaining competitive advantages. The housing market showed some softness, with construction falling 8.5% in August and permits dropping to their lowest level since 2020. While this reflects affordability challenges, it's essential to remember that housing often leads economic cycles by several months, making this information valuable for forward-looking investment decisions. The encouraging news is that mortgage rates have begun declining following the Fed's actions, which could provide relief for buyers and builders ahead. For our portfolios, this creates opportunities in well-positioned home builders that can benefit from improving affordability while suggesting caution toward companies heavily dependent on discretionary home spending. Now let's look at what drove our performance over the past week and why we remain confident in our positioning. Tesla was our standout performer with a close to 13% gain last week, demonstrating why we continue holding this innovative company despite its premium valuation. The surge came as investors recognized Tesla's exposure to both electric vehicle adoption and artificial intelligence development, two of the most powerful long-term trends globally. What's encouraging is Tesla's ability to benefit from multiple growth drivers simultaneously, from expanding EV market share to advancing autonomous driving and robotics applications. While Tesla can be volatile short-term, we own it because of the management's execution track record and their position at the intersection of transformative technologies. Their scale, innovation capabilities, and brand strength create competitive advantages that are difficult for rivals to replicate. The consumer discretionary sector was our strongest performer, contributing meaningfully through holdings like Tesla and Amazon. This strength reflects continued consumer resilience and recognition that well-positioned companies can thrive, even in challenging environments. What we particularly like about our consumer discretionary holdings is their combination of strong brand loyalty, diverse revenue streams, and adaptability to changing preferences. These aren't speculative bets on consumer spending, rather investments in companies that have demonstrated the ability to gain market share regardless of conditions. The sector's performance validates our focus on quality businesses with pricing power and competitive moats, rather than companies dependent solely on overall spending growth. Our size strategy delivered exceptional results, with large cap holdings like Tesla, Apple, and Alphabet all contributing strong gains. During uncertain times, investors naturally gravitate toward companies with resources and scale to navigate complex challenges. Large companies possess several advantages to become more valuable during uncertainty: financial strength to invest through downturns, global reach to capture opportunities, and management depth to adapt strategies as conditions change. While some may worry about a concentration in mega-cap stocks, we see this leadership as well-earned through superior execution and sustainable competitive advantages. These businesses generate substantial cash flows, maintain strong balance sheets, and possess the scale necessary to compete in an increasingly complex global economy. Looking ahead, here are the key events we're monitoring that could shape markets in the coming week. Tuesday, September 23rd, will bring Fed Chair Powell's first major speech since the rate decision, offering crucial insights into the central bank's thinking. Given the divisions within the Fed that became apparent on Wednesday, September 17th, with Governor Myron pushing for a larger cut, Powell's remarks will be closely watched for clues about future policy moves. Markets will be particularly interested in how he addresses the balance between supporting employment and managing inflation risks. Powell's speeches often provide more nuanced views than formal Fed statements, potentially offering insights into whether the 25 basis point cut begins a more aggressive easing cycle or was a measured response. His comments could significantly influence both stock and bond markets as investors adjust expectations for the remainder of the year. The morning of Thursday, September 25th, will bring weekly jobless claims data, our most timely employment indicator. Recent trends have shown some softening, which was part of why the Fed began cutting rates this week. We'll watch to see if this continues or stabilizes at current levels. Strong employment supports consumer spending and corporate profits, making it key for both bond and stock markets' health. While unemployment remains relatively low historically, significant changes in weekly claims can signal broader shifts before they appear in monthly reports. Given the Fed's focus on employment as part of its dual mandate, this data will be particularly important as markets assess whether additional rate cuts may be needed to support job growth. Friday, September 26th, will bring data on the Fed's preferred inflation measure, the core PCE price index, which excludes volatile food and energy prices to show underlying inflation trends. This data is crucial because it's closely watched by the Federal Reserve for policy decisions. Given Chair Powell's comments this week about goods prices driving most inflation pressure, investors will focus on whether these trends are accelerating or moderating. The core PCE often moves differently from other inflation measures, providing unique insights into consumer price pressures. For our portfolios, this will help determine whether the Fed's rate cut was well-timed or if additional adjustments may be needed. The reading could significantly impact both growth stocks and interest-sensitive sectors in our holdings. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you next week.